The student loan burden in America has grown into a defining financial issue for a generation, with ripple effects far beyond individual borrowers. It influences how families spend, when people buy homes, and whether new businesses get off the ground. With total balances now in the neighborhood of $1.8 trillion and tens of millions carrying federal loans, the scale alone demands practical solutions that work in real life, not just on paper. To talk about fixes, it helps to be clear on what's driving the numbers. Tuition has climbed faster than general inflation for decades, especially as public support for state schools lagged, campus costs rose, and amenities expanded. Many students still arrive on campus without strong personal finance knowledge, sign complex promissory notes, and only later see the long tail of interest. For a lot of families, borrowing feels like the only door into a degree that employers still value for many roles. The result is a path to opportunity that too often comes bundled with years of payments and trade-offs. One lever sits with public funding and aid design. When states and the federal government prioritize support for public colleges, community colleges, and need-based grants, the sticker price and the net price diverge in borrowers' favor. Streamlining how aid is awarded matters too. Recent FAFSA changes shortened the form and shifted to direct tax data transfer, reducing friction and errors, and replacing EFC with the Student Aid Index, which can be negative to better identify high need. Changes intended to make aid targeting more accurate and the process less daunting for families across the U.S. Another lever is repayment policy. Many borrowers benefit when payments flex with income and family size. The Department of Education's adjustments to count prior qualifying months are bringing some borrowers closer to forgiveness under income-driven repayment and, for eligible public servants, PSLF, an administrative fix that recognizes past credit where due. At the same time, debates continue over proposals that would overhaul income-based plans in ways that could raise required payments for some earners. Design details matter because cliffs and steep step-ups make budgets harder to manage for lower-income households. Forgiveness remains part of the conversation. Programs like public service loan forgiveness are designed to trade years of work in nonprofits or government for balance cancellation. When the rules are clear, paperwork is manageable, and qualifying payments are counted correctly, these programs can deliver on their promise, particularly for teachers, nurses, first responders, and other public-facing roles. Where complexity blocks access, simplifying enrollment and improving servicer guidance can restore confidence and reduce the frustration borrowers often report. None of this replaces what borrowers can do right now. A few practical steps go a long way. Confirm loan types on the federal student aid dashboard, check eligibility for income-driven plans, and consolidate only if it preserves or improves access to benefits. Build a basic budget that captures rent, utilities, groceries, transportation, and a realistic payment. Automate transfers when possible. If cash flow is tight, revisit the chosen IDR plan. Small paperwork lapses can push payments higher than necessary. For windfalls like tax refunds, consider a split, some to emergency savings, some to principal on the highest rate loan to trim long-term interest. These habits don't eliminate debt overnight, but they reduce stress and create options. An equitable approach matters. Debt is not distributed evenly, and communities with fewer resources often borrow more and repay longer. Centering equity means making sure aid formulas capture need accurately, that campus counseling reaches first-generation students early, and that program outcomes, graduation, earnings, default rates, are transparent so families can compare options. When colleges publish clear program-level metrics and the aid system recognizes differing needs, students can choose paths with eyes open and less risk of negative surprises. Progress also requires coordination. Federal and state agencies, higher ed leaders, employers, and non-profits each hold pieces of the puzzle. Partnerships can expand work-study aligned to in-demand skills, scale emergency aid to keep students enrolled through setbacks, and improve data sharing so borrowers don't fall through cracks during servicer changes. When stakeholders pull in the same direction, simpler aid, clearer disclosures, responsive repayment, the system becomes more predictable and easier to navigate for families. It's equally important to broaden the conversation beyond a single 4-year route. Certificates, apprenticeships, and 2-year programs can offer faster, lower-cost paths into solid jobs. When high schools, community colleges, and employers align curricula with local demand, students gain a credible alternative to heavy borrowing. Strengthening these pathways doesn't devalue bachelor's degrees. It gives Americans more ways to reach stable earnings with less debt risk attached. Stepping back, student debt is a financial reality and a policy challenge. The numbers reflect choices made over many years about funding, pricing, information transparency, and repayment design. But the options in front of us are concrete. Increase need-based support where it moves the needle most. Keep the FAFSA simpler and more accurate. Ensure repayment tracks income predictably, maintain and streamline PSLF and related relief, and equip every student with the budgeting and borrowing basics needed to avoid costly missteps. For borrowers, the action plan is practical. Verify loan details, choose the right repayment path, automate what can be automated, and reassess yearly as income and family situations change. For institutions and policymakers, the task is to keep lowering administrative hurdles and aligning payments with the realities of American household budgets. Do those things consistently, and the degrees promise greater opportunity with manageable risk comes back into focus for more people. If this topic is on the table at home, consider starting with a 30-minute review of your federal student aid account, a side-by-side of repayment options, and a calendar reminder to recertify income before the deadline. Small, timely steps compound into fewer fees, lower stress, and better outcomes. That is how individual progress connects with system improvements and how higher education can remain a path to possibility instead of a source of lingering financial strain. Sources and context informing this script include current summaries of U.S. student loan balances and borrower accounts, recent FAFSA simplification and the new Student Aid Index, and federal adjustments that credit prior payments toward income-driven repayment and PSLF eligibility.